Smart money just repositioned over $3 billion this week. Retail traders are aggressively selling this massive rally, but institutional flow is telling a completely different story. Welcome to this explainer on gold. We're looking right past the retail charts today. We're tracking real institutional capital. Most traders are looking at the wrong signals entirely. They trade retail patterns while institutions build massive positions. We're going to look behind the curtain today. We'll expose the actual footprints driving price right now. 130,766. Take a good hard look at that number. That's a massive institutional footprint right there. It's the exact number of net long gold contracts, and these are currently held by smart money. They're not just guessing or gambling out there. This is highly calculated institutional positioning. They are gearing up for a massive pricing event. Something extremely big is brewing in this market. If you leave now, you'll completely miss the real story. There is a massive disconnect happening right now. Retail traders are blindly selling at all-time high resistance. They desperately think the market has finally topped out. They look at historical highs and instantly hit sell. But institutional flow tells a completely different story. Institutions are aggressively accumulating massive long positions. They're buying the exact levels retail heavily shorts. Why do they do this? They need retail liquidity to fuel their own long entries. They are literally using your stop losses as their entry tickets. If you only read candlesticks, you're totally failing. You are barely seeing half of the real story. Candlesticks just show you where price has already been. They completely miss the institutional footprints driving the trend. Stop obsessing over arbitrary retail chart patterns. A double top means absolutely nothing without structural context. You absolutely must start reading market liquidity instead. Liquidity reveals actual institutional intent and future algorithmic targets. Institutions simply do not care about your retail trend lines. They only care about where the outstanding orders rest. We don't just read raw numbers here. We translate commitment of traders' data directly into behavior. Managed money holds over 130,000 net longs. This represents highly aggressive trend accumulation. Swap dealers are deeply short by 207,000 contracts. They are desperately hedging this massive speculative rally. Producers are actually reducing their overall short pressure entirely. This means commercial hedging is clearly backing off. And other reportables are just blindly following the speculative buy flow. Every single data point screams much higher prices. Let's examine the macro catalysts driving this massive accumulation. The US Nonfarm Payrolls just missed expectations massively. They reported negative 23,000 jobs. This sparked an absolute bullish storm for gold. Treasury yields completely collapsed across the entire curve. Lower yields remove the penalty of holding non-yielding gold. Capital is violently rotating out of the weak dollar right now. The dollar index rapidly lost over 6,000 open contracts. That capital is flowing directly into safe haven assets. But stay sharp for US core CPI volatility this week. Now let's map this macro data directly to price action. Our daily market structure shows a massive bullish shift. We have a clear and decisive change of character. This was instantly followed by a massive break of structure. Smart money has officially shifted the higher time frame trend. We are no longer in a choppy, ranging environment. The fundamental macro environment supports this technical shift perfectly. Price action is aligning flawlessly with institutional capital flow. The daily trend is firmly locked into a bullish trajectory. Fighting this higher time frame structure is absolute suicide. So we need a highly precise zone for our entry. We have a massive, unfilled fair value gap resting below. It sits directly between 4280 and 4295. This is our absolute primary discount array. It acts like a massive magnet for institutional limit orders. Smart money deliberately left this gap during the aggressive expansion. They will often return here to mitigate early positions. We want to see price pull back into this specific zone. That's exactly where the heavy institutional accumulation will resume. Zooming into the internal structure reveals classic institutional manipulation. Price is consolidating tightly just under the absolute highs. Retail traders see a standard double top resistance pattern. They are actively selling right now in this exact consolidation, and they're placing tight stop losses right above these equal highs. This creates a massive external liquidity pool resting above. Smart money is engineering this specific liquidity pool deliberately. They're compressing price to induce early retail short sellers. They'll eventually sweep those highs violently to fill their orders. My primary bias for next week is unequivocally a buy. This aligns perfectly with macro data and institutional order flow. Our high probability entry zone is 4290 to 4305. We're placing our stop loss safely at 4268. This sits firmly and safely below the key order block. Our first target is that engineered liquidity sweep at 43.40. Secondary targets will scale out at 43.80 and 44.20. We let momentum carry our runners straight into those deep levels. Every professional trader operates with a strict invalidation level. Hope is absolutely not an institutional trading strategy. This entire bullish bias is immediately invalidated below 42.50. A daily candle closing strictly below that level ruins everything. It means smart money has abandoned the long accumulation program. We don't just hold and pray if that level breaks. We immediately kill the trade to protect our capital. Never argue with the market when it proves you wrong. I want to leave you with one core institutional concept. Seriously, write this exact quote down and memorize it today. Retail traders will always blindly react to price. Institutions will always patiently react to liquidity. Price moves aggressively toward liquidity, never toward your personal opinion. Retail chases green candles, while institutions target deep liquidity pools. Align yourself strictly with the institutional footprint starting today. Stop trading standard patterns without understanding the underlying order flow. This single mindset shift changes absolutely everything. If you want to trade alongside professional order flow, act now. To follow future trading opportunities and detailed market breakdowns, open your trading account using the link in the pinned comment. Make sure to subscribe to the channel for more explainers. Leave a comment below with your specific thoughts on gold. Are you currently trapped in shorts or riding the institutional longs? Apply these exact concepts to your own charts immediately. I'll see you in the next explainer. Stay disciplined and protect your capital out there.